Ladies and gentlemen, good day and welcome to the SBFC Finance Limited Q4FY25 earnings conference call, hosted by ICICI Securities. As a reminder, all participant lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Renish Bhuva from ICICI Securities. Thank you. Over to you, sir.
Thank you, Sejal. Hi, good morning, everyone, and welcome to SBFC Finance Q4FY25 earnings call. On behalf of ICICI Securities, I would like to thank SBFC Finance management team for giving us the opportunity to host this call. Today, we have with us the entire top management team of SBFC Finance, represented by Mr. Aseem Dhru, Managing Director and CEO, Mr. Mahesh Dayani, Chief Business Officer, Mr. Narayan Bhatia, Chief Finance Officer, Mr. Pankaj Poddar, Chief Risk Officer, and Mr. Sanket Agarwal, Chief Strategy and IR Head. I will now hand over the call to Mr. Aseem for his opening remarks, and then we'll open the floor for Q&A. Over to you, sir.
Thank you, Anish, and good morning, everyone. Thank you for being on this call. This is our 30th quarter result since start of SBFC and the 8th post-listing. The amazing thing about being a financial services company is that being a proxy of the economy, we are affected by every breeze that blows in every sector. From the macros like fiscal and trade deficits, interest rates, liquidity situation, GDP growth, money moving digitally, currency movements to the micros like the economy shifting to being more organized, individual balance sheets moving up and down, velocity of money in small businesses, working capital cycles, everything. There are multiple forces at play right now. Finance is a derived demand, and to understand its strength, we have to look at the primary demand in the economy. Economic growth in India chugs along, albeit at a slower pace. What we have seen is that all the consumer staple companies have reported flattish quarter. So whether it is HUL, Nestle, Dabur, etc., at 2% growth, it's anemic. But look what's happening to the discretionary. So when you're looking at airlines, hotels, you are able to see that where spending is going. So spending is changing. We'll have to change our lens of focus to arrive at where the consumer spending is heading. So no longer looking at consumer staples may be a right barometer to look at. Inflation is in the tolerance zone, and the regulator has shifted his lens on growth. 2 rate cuts have been delivered in rapid succession, and looking at the inflationary trajectory and softening of the USD, more rate cuts look to be on the menu. Durable liquidity has been promised and is being delivered. Banks have begun to cut savings rate. Deposit rates have been able to soften after peaking in March. Looks like MCLR reductions are around the corner. Banks are the wells from where the NBFC fields are irrigated, and so it's great to see them well hydrated versus the challenge last year. On product design of gold loans, there was ambiguity and interpretation issues. The new draft circular provides immense clarity, and the regulatory risk on the business continuity, which was a concern all of last year, is now off the table. The draft co-lending circular may make CLM2, on which the industry is operating, challenging. We are probably the only lender operating on CLM1, so we should be fine, and that is our current understanding. DeepSeek has done a number on ChatGPT. One of the most difficult things to achieve is the balance between technology and cost. Achieving frugal tech scale is a challenge we have taken. We have built some very effective tech stacks on cloud using vendors and self-development mix, and built over 200 APIs to draw from the best. The benefits of these have begun to roll. We have just gone live with a paperless gold loan. When a customer visits our branch today, just with her iris scan, we have eKYC, e-sign done, and money is the customer's account, an agreement on her WhatsApp. That's it. No documents, no friction. The challenge now, is that the transaction is over before the customer's tea arrives. So we have a problem of a different kind. We have rolled out account aggregator and are seeing increasing adoption, helping us speed up decisioning time as well as end-to-end monitoring, end-use monitoring. We have been working on a project with Amazon Web Services. It's a generative AI-assisted credit assessment. The virtual credit underwriter should roll in this year. We've been piloting it softly, and we'll roll it once we see the results. Our assumptions for the year ahead are as follows. 1, we will endeavor to grow at 5 to 7% quarter on quarter. There will be quarters like the Q4 where we will surprise ourselves, but this continues to be our guidance. 2, we have been guiding a 50 bips reduction on in operating year on year due to the design of taking a fully loaded OPEX of 16 states to listing and then benefiting from scale and efficiency. 3, last year against the guidance we have delivered a 69 basis point reduction. In the coming year we will endeavor to deliver another 50 basis points cost reduction. 4, we will put out 20 to 25 branches this year as well. 5, we are not penciling in any reduction in cost of funds. If it happens, we will take it as a bonus. Usually what happens is that on Excel sheets we take the good news in, but bad news always arrives from where you can't see. So we'll keep this parked aside. 6, co-origination will remain at the 20% of our incremental origination. Nothing changes there. Gold will remain 15 to 17% of our book, no change. 8, we will be holding on to our view of closely watching our credit cost, and it should move in the 1% plus minus 10% plus minus 10 basis points range. It's funny how humans think in terms of adding zeros to scale. When you start the company, the milestones you think of tend to be 100 crores, 1,000 crores. This year, we are looking forward to us crossing 10,000 crores of an AUM number. While one knows that the top line is vanity, bottom line is sanity, and cash flow is reality, the ultimate measure of an NBFC will always be scale, profitability, and governance, and we will strive towards that. So to conclude, we have put ourselves in a position where good things can happen to us, but we know that while that is a good condition precedent to have, it is only through disciplined execution that we can get to where we want. So help us God, and now over to Narayan for more detailed comments.
Thank you, Azim. Good morning, everyone. Our AUM for March 2025 is 8,747 crores with a growth of 28% on a YY basis and 7% on QOQ basis, with 100% of our AUM now secured by properties and gold. Our MSME AUM, which is 83% of our AUM, grew by 27% YOY and 7% QOQ to rupees 7,249 crores. We added 22 branches during the year, 8 branches during the last quarter, with total branch count now stands at 205 as of 31st March 25. In terms of yields, spreads and OPEX, the yields and spreads continue to remain stable at 17.88% and 8.53% respectively for the quarter. Our borrowing cost has reduced 5 basis points YOY and is at 9.33% for the full year, in spite of continuous increase in MCLR during the year. Our OPEX is flat compared to previous quarter and is at 4.62% for the quarter, but improved by 39 basis points from Q4 of previous year due to operating leverage increase in the organization. This is in spite of a consistent increase in the branch network. In terms of asset quality, our GNPA is range bound in Q4 to 2.74%, with PCR increasing to 45.69%. Our credit cost is 1% for the quarter, which is in the range of our guidance. In terms of capital and return ratios, our capital adequacy ratio is 36.1% with tangible net worth of 2,900 crore as of March 25. Our return on average AUM for the quarter is 4.52%. with return on average tangible equity further improving to 13.14% for the quarter. We made PAT of 94 crore for the quarter, thereby reporting a growth of 29% on a YOY basis and 7% on QOQ basis. And the PAT for the full year is at 345 crore, which has grown at 46% on a YOY basis. With this, we open the floor for question and answer.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Nischint Chawathe from Kotak Institutional Equities. Please go ahead.
Hi, thanks for taking my question. Just a little bit qualitative. I think you mentioned that, be a little bit more cautious, in the current environment. Now, is it just kind of a fear of unknown, or is it something that you're tangibly able to see at the ground?
So see, Nischint, you are the only man who's Nischint. All of us have a lot of chintas. So, that was on a lighter note. But basically, see, the way we see it is that if you look at the last few years, there has been a lot of volatility that has happened. Some came from liquidity events, some came from nature like COVID, some came from man-made events and crisis, and some came from regulatory pressures that built, and some have come from on-ground issues that what we have seen in Karnataka, and now what we are seeing in Tamil Nadu. So there have been a series of events that have happened, and every year there has been something that has disturbed the flow. So one needs to be careful and one needs to be watchful. We don't know, what the future entails. And the fact is that when we are lending to a customer segment which is a higher risk segment, and therefore we have to be a lot more watchful always. So I don't think our commentary will ever change. Whichever year you will hear the call in. Because it is easy to see. It's a difficult business. Apart from one player, there has not been anybody who's been able to build scale in this business over time. So it's a difficult business. We recognize that, and we know that we have to be watchful. It's a slippery slope. We will have to be watchful. Nothing that there is an event right now, but every year some event seems to be coming that we can't see.
Fair point, got it. Just a little bit of, again a little bit of quantitative maybe. On the asset side with rates coming down, how fast do you think you need to transmit? And, any specific reason why you said that, you don't want to pen down any cost of benefit this year?
So see, it takes time to transmit. Even this, while the rate cuts happen, incremental borrowing costs have already begun to come down. But the book doesn't reprice until MCLR moves, etc., which will take time. I mean, there is a pressure on banks also on net interest margin maintenance, etc. So I don't see that transmission of rate cuts, and durable liquidity is going to immediately come to us. So it may come by the second half of the year, and it may come in small spurts. So 5 basis points here, 7 basis points there. We don't see a material reduction in cost this financial year, is the base case. If it comes, we'll take it with both hands. And the transmission only happens when our cost of fund moves, and our other parameters, move. So transmission, so there will be a delay and a lag between transmission of what happens by the regulator and what happens at the banks. Similarly, there will be a lag at what happens, to us and what will ultimately get transferred to the customer. So I don't see any rate reduction possibility, for customers this financial year at least.
Sure. Because between 22 and 24, when rates were rising, you actually did see a spread expansion. So I'm just trying to understand the behavior.
So see, what happens is, the rise was very sudden then. It was at one stroke, you had a 250 basis point increase. It was a very abnormal rise, so everyone had to react and respond to something that was, abnormal event. This year, I mean, it's nobody's case that we are looking at that kind of a rate reduction, So, when it is big, the shock and the reaction is instant. When it is in small spurts, it takes time to transmit through.
Got it. Any change in outlook for gold business after the draft regulation from RBI?
No. So hi Nishit. So there's nothing materially changing for us. In fact, we'd like to welcome the draft circular, which is in circulation as of now. So nothing changes for us. So for last year, on an average, while there was volume growth of 15%, the price movement of almost close to 24-25% took our average growth to 40% in gold. So clearly nothing changes for us either operationally or otherwise.
Got it. And just one tiny one, last one, if I can squeeze, on the co-origination side, I think as rates go down, do you kind of tend to benefit? I mean, I'm just curious how the pricing is for you.
So effectively, it's a zero-sum game, because the rates are linked to repo both ways.
Both ways. Okay, got it. Perfect. Thank you very much.
Thank you. The next question is from the line of Renish Bhuva from ICICI Securities. Please go ahead.
Hi, sir. On two things. So one, on this 1+ DPD trend, right? So we have been witnessing a steady increase in 1+, but at the same time, of course, we've been also able to contain close to 90 plus. I mean, that's what our gross NPA friends suggest. So just wanted to get a sense, which geography or pocket is sort of driving this higher flows into early buckets. And do you see any risk to the pace of outflows from 1 plus to 90 plus in coming quarters, maybe because of this tail issue or any other micro event that can create?
Yeah. So on the 0 plus, basically we have seen impact of Karnataka portfolio because of certain events, and due to that we are seeing that impact on 0 plus. We are not seeing any material movement at this point in time due to the same. So forward looking for full year, we are not changing our forecast.
Okay. So got it. So incremental flows to early buckets is mainly because of Karnataka issue.
Majorly 50 basis point is due to the same.
So Nilesh, all other states have been constant in the quarter, and the only impact that is coming from Karnataka. We have a material portfolio there, and therefore that in the bucket 1 has got impacted, and therefore 0 plus is bloated to that extent. But in all other states, we've been able to contain the asset flow.
Okay. And maybe if you can just share the ground feedback currently. I mean, things have stabilized in terms of flows, or how is it?
So obviously, this started somewhere at the beginning of the last quarter, and all I can mention is that sequentially we're seeing improvement month on month. So Feb was better than Jan, and March was obviously better than Feb. So obviously sequentially we're seeing it better.
Got it. Okay. And maybe slightly related to that also is on the disbursement side. So on full year basis, we saw our disbursement in secured SME is actually down. And now sort of when we are saying, sort of we able to maintain or sustain this 5 to 10% sequential growth. If I just back calculate the numbers, the ask rate for quarterly disbursement, would be roughly 850 plus crore. So are we confident of sustaining or achieving those numbers from the new issue in TN?
Yeah, so probably I'll just break up the numbers for you. So what you see on a full year basis is largely because of a 1 quarter impact, which was the quarter 1 impact, where the total numbers had dropped to closer to 550 crores, and then thereafter there was a sequential uptick in it. If you were to just pencil in a number of anything between 4 to 5 odd %, you would continue to grow upwards of 20% in disbursals, or closer to 25% of disbursals, and also in terms of your AUM growth is going to be more than 25%, and that clearly mirrors a 5 to 7%. We were averaging close to around 255 odd crores a month last quarter, and that's going to take us to more than 300 or closer to 300 crores by the end of the year. So that's not a very large ask that we have before us. So if we were to go with your number, seems to be largely within our range.
Got it. Okay, that's it then. That's all.
Thank you. The next question is from the line of Devesh Kayal from Monarch AIF. Please go ahead.
Just one question. So our growth in the western region has been kind of muted at around 12%. So if you can give some color on this. Yeah, thanks.
A soft pocket for us, and some part of it is by design. Some of the states we had last year consciously had slowed down because we weren't very comfortable on the numbers that were coming up from the industry perspective. The numbers seem to be looking a lot better. So moving forward, we would see an accelerated ramp up, and that's where the opportunity for us to hit our required ask on the disbursal also comes through.
So does that answer your question?
Yeah, that's it from my side.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question. The next question is from the line of Shreya Shivani from CLSA. Please go ahead.
Yeah, thank you for the opportunity. I just wanted to understand, you talked about opening 20 to 25 branches in the coming year. How do you decide on which geographies to expand in? Is it district by district expansion? Can you talk a little bit on that? And there was a media article yesterday which talked about certain regulation coming in Tamil Nadu, which may try to formulate rules around collections. I see you have lesser number of branches in Tamil Nadu than Karnataka, so I can understand the impact could be restricted. But if you can help us understand what are the stress, if there is any stress in that state going ahead.
Yeah, so answering your first question with respect to branches, so if you would have looked at our number of states, we're not adding any state. What we've been constantly maintaining is that we're going to get deeper into every state, depending upon the experience that we have on origination, on underwriting, and on the profitability for those states. And the way it works for us is that we get deeper at a district level as we move into each of these states. So our existing states are going to get stronger. You would see better outcomes coming in from the states where we are already present. Some of them, we are the flag bearers in those particular states where we have a significant market share, and we will continue to strive deeper in those particular markets. Answering your second question in terms of the Tamil Nadu exposure, we have a 3% overall exposure. We'll be a little watchful as to how the situation unfolds in this particular quarter before deciding to significantly ramp up.
Got it. And so one thing that I wanted to understand, you mentioned how, the environment in the country has been volatile in the past so many years. So within the segment, how do you maneuver around sub-segments? I'm not talking in terms of if you're doing secured MSME, not in terms of one state has more stress, so I move to other state. That is understandable. But do you choose, the kind of MSMEs that you are lending to, or you move that around also? And are there any sub-segments of MSME where you feel there is bigger stress right now?
So, in our previous commentary, we've said that our decision to lend or go slow is a function of multiple things. It's not really related to an event. Probably something what happened in Karnataka or Tamil Nadu is probably a situation which is solving for excesses. But our decision is largely more credit driven and how is the market being driven in those particular states. So a couple of states we had slowed down last month. That was largely driven because of the delinquencies going up in that particular segment, not necessarily with us. And also the entire efficiency of login to approvals to disbursal ratios. If that's not really favorable, then it's a high cost impact for us. So independent of these particular spurt of events, because these will ultimately settle down, but our decisions to grow, accelerate is dependent upon a lot of other functions, which also mirrors up, your question saying that what is it that we look at the segment. So when we look at segments, we look at how are the big tickets doing, how are the mid tickets doing, how are the low tickets doing, how is the 0+ moving, how is the 90+ transition happening, how the disbursals moving. So a lot of those considerations come into play before we decide what the plan for the quarter and the full year is going to be.
Understood. Thank you so much. This was very useful.
Thank you. The next question is from the line of Kamal Mulchandani from Investec Capital Services. Please go ahead.
Hi, sir. Thank you for the opportunity. My first question is, with respect to the increase in 1+ DPD in the recent quarters, have we put in some incremental credit filters, and what are we doing extra in terms of collection efficiency, improving our collection efficiencies?
So 1+, as we articulated earlier in the question, that it is we have seen impact of Karnataka coming in 1+ in last quarter, and that has impacted us 0+ by 50 basis points. We are seeing this to stabilize in coming quarters, and for full year we are not expecting any material impact of the same. From a credit side, we continue to watch the space, and internally we have been strengthening our collection processes in past couple of years. So basis the same, we are not changing any guidance for full year.
Okay. Okay. Secondly, for your gold finance book, if you could just highlight the number of branches from where we are sourcing this book, and incrementally, are we seeing some growth in the tonnage as well, or it is purely related to the increase in gold prices?
So in terms of the tonnage, in terms of volume growth, the split is 15% is largely driven because of volume, and 25% is the benefit that we got in terms of the price increase, average price increase. And that's how it sums up your 40% growth in the gold business.
Okay. And branches from where we are sourcing the gold alone, if you could just tell the number.
165 branches.
Okay, cool. Thank you so much. That's all from my side.
Thank you. The next question is from the line of Kunal Shah from Citigroup. Please go ahead.
Yeah. Hi. So firstly, with respect to the overall ECL provisioning and particularly on stage 1, so that has got reduced by almost like 20 odd basis points. While we have seen the coverage increasing both for stage 3 as well as stage 2. So not very sure in terms of what is leading to change. Obviously, you also indicated that the environment is uncertain. So then this would be on a back pull, but still, do we plan to increase the coverage or something, and what could be the reason for this decline?
No. So see, we refreshed our ECL model, and this has come out of that model. We had, probably we were over providing. Even now, we are providing higher than anybody else. So this is just when what's come out. We have completely automated our ECL provisioning. So there is no manual intervention. We do management overlays over and above this, wherever we deem fit. So, but this number that's come out of the model, and even after reduction, it is still highest compared to anybody else you would see.
Okay. And management overlay, what would be that number today, if there is any? Yeah.
Around 4 crores.
4 crores. Okay. Okay. And secondly, when you indicated with respect to the cost of funds remaining stable, so that comment is only on cost of funds. It's not, say, with respect to spreads. So looking at maybe the overall funding cost environment, there could be some lag, but we should have that advantage. And given that the proportion of maybe more than 700 customers is also rising, okay, would there be further pressure on yields and margins could come off? Would that be the case?
You have seen us over 8 quarters. Even in increasing cost of funds, our spreads have only gone up.
Okay. So still, maybe even though funding cost remains similar, then not much pressure on spreads would be there. That's what the indication is.
No, as I already laid out in my guidance, nothing changes. Everything remains what we had said in the run-up to the roadshow. It is.
Okay, got it. Thanks. Yeah.
Thank you. The next question is from the line of Satish Kumar from Mirae Asset Capital. Please go ahead.
Yeah, thanks for the opportunity. So 2 questions from my side. First one is related to the cost to income ratio. As the cost of income ratio is to around 40%, and the company has adequately invested over the past few fiscal. So would we expect the same trend going forward for the cost of ratio fronts? And the second one is the MSME segment. So what is the growth guidance for the MSME credit growth, given the competition is rising for these segments?
So with respect to the MSME segment, I think the overall market, if you look at it, that's close to around 3.5 lakh crores in the category of 5 to 30 odd lakhs, and that's growing in the range of 20 odd percent. So we, with a lower base, if we are projecting 5 to 7% on a quarter-on-quarter basis, that is something which is achievable, and that's something that we've been maintaining for the last couple of years. We don't see any of those variables changing. We've invested in our distribution across the country. So some spurt here or some event here or there is not going to probably change the guidance in any form. So clearly, while the competition could be getting intense, but I guess the market is also growing enough, and there's adequate and enough and more opportunity for most of the players to.
Okay. And on cost to income ratios front, sir?
OPEX side, I think what always guided is that we will reduce our OPEX by largely 50 basis points as the distribution tends to spend. Last year, our OPEX went down by almost 70 basis points. Our next year guidance also for the same remains the same, that we will reduce it by 50 basis points. So it is going to be a downward sloping curve that you would see on our OPEX to AUM or the cost to income, whichever way you derive that.
Okay, thank you.
Thank you. A reminder to all the participants that you may press star and 1 to ask a question. Ladies and gentlemen, you may press star and 1 to ask a question. The next question is from the line of Mayank Mistry from JM Financial. Please go ahead.
Hi, sir. Thanks for the opportunity. Sir, I have two questions. First is basis on the gold draft that has came in. So, do we have any consumption-led loans in our portfolio? And if yes, then how should we see the growth going forward, given that it is said that the growth is going to be impacted for gold loans going forward? So, although we are at the higher end of our guidance, should we see this move below 15% going forward? And secondly, what would be our Tamil Nadu exposure? Because again, the same regulation, same ordinance has been passed by Tamil Nadu as well, which has been passed in Karnataka. So that are my two questions. Thanks.
So with respect to the Tamil Nadu exposure, it's close to around 3% of our AUM, so the exposure is not very large, significant. As I had maintained earlier in the call, that we will be a little watchful as how the events turn out, and then depending upon those, we will decide our acquisition in that particular state. So as of now, it's not a very large material event for us, which will impact our overall momentum. Your question on gold with respect to consumption, I think let me break this into two parts. What you see, consumption-driven loans are largely small ticket loans in gold. What we typically see is more than our average ticket size is slightly more than 1 lakh, closer to probably 1,10,000 to 1,20,000. These are largely business owners or used for business purposes. So the impact towards the drawing towards consumption-driven loans is also going to be limited.
So what would be the currently mix of income generation and consumption loans in our book then?
It will be mostly consumption. So basically loans for which we would be offering in gold loans.
Gold is a very small portion of our book. We are an MSME lender. That's our focus. Gold will remain at this 15-17%. No change.
Okay, sir. Thank you. And all the best.
Thank you. The next question is from the line of Vignesh Iyer from Sequent Investments. Please go ahead.
Hello. Thank you for the opportunity. So my question is on can you give us some idea on how the bounce rate has been in the current quarter? And with your initial commentary on some elevated risk in few states, how do you see? How do you think it will pan out? In next 2 or 3 quarters.
We usually track 0+ as a matrix in the segment, and bounce rate for the last 1 year has remained flattish from our portfolio perspective. 0+ has been one of the tracking points that we are looking at, and that's where our collections have been driven.
Oh, okay. And sir, what do we have as an internal estimate for a steady state ROA on our AUM?
So ROA has been ranging around 4.5% from the last 6 odd quarters, and as we lever up, there will be some compression on the ROAs, but we would want to hold it on for the next 1 year between 4 to 4.5%.
Right, got it, sir. That's all from us.
Thank you. The next question is from the line of Harshit Toshiwal from Premji Investments. Please go ahead.
Hello, sir. Hi, am I audible?
Sir, I would request you to please use your handset.
Hello. Hello.
Yes, sir.
Is this better? Yes. Sir, the question was on the gold loan piece itself. I think specifically on these two, that how's our structure of the gold loan in terms of bullet repayment or principal EMI, and with the LTV norms changing, how should we look at that piece itself? Maybe for you and also for the sector, if you can help us. Right, and the second is from the increasing intensity of requiring to document the purpose, etc. How should that be looked at? Thank you, sir.
So from an LTV perspective, our overall LTVs on the gold portfolio is close to around 50-odd%. So at a portfolio level, obviously we have a required margin of safety, so that's not an issue. With respect to the new draft circular which has come into play, we are already following that circular. So for us, there is no material change that we see with respect to the LTVs, which is in play. What was your third question?
On the increasing documentation piece, sir, so I think you said given most of our loans are income generation, but do we now need to put in some additional efforts in terms of documenting the end purpose of loans? Or practically, how is that possible?
So I think that was a soft nudge which was always there from the regulator to monitor the end use for the gold loans. For a particular ticket sizes and above, so that was already into play. We will just have to see that whether it is for the entire spectrum or is it for certain ticket sizes. If it's for certain ticket sizes and above, then there is no change for us. In case it is for the entire spectrum, that's the only incremental or marginal effort that will be required from our side. But on an overall impact basis, we really won't have to turn the entire tumbler up and down. On this one, whatever changes are going to be there are going to be marginal and not really extremely, it's not going to impact our cost in any way.
Okay, sir, one last question. That our repayment structure in the gold loan, is it a bullet-based repayment?
See, if you look at the circular, what it tends to say is that if you have a ballooning structure where you balloon all your interest and everything is rear-ended, there could be an event risk in case the gold price falls, and that's rightfully done in. Thankfully, we are largely on a monthly servicing that we do it or on an EMI basis. So again, to that particular, the portfolios that have been mentioned, and we don't have a share in that particular bucket or that particular product in our overall portfolio. So again, the impact assessment on that particular point is also minimal for us.
Got it. Thanks a lot, sir.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question. A reminder to all the participants that you may press star and 1 to ask a question. As there are no further questions from the participants, I would now like to hand the conference over to the management for closing comments.
Thank you. That's it from our side.
Thank you. On behalf of ICICI Securities, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.